Eliades is his name, the Stock Market Cycle's editor and publisher. Peter is a tad more bearish than the guests we had at the outset of the show. That's by design. I wanted you to hear from a bull, and now I want you to hear from someone who's, well, let's say not so bullish. Peter, good to see you again, my friend. You don't like the same market that a lot of bulls are seeing. Why not?
Yeah, Neil, you know, you and I spoke a couple of months ago, and I pointed to February 9th, because what happened on February 9th was rather historic, although if you ask someone in Wall Street how historic it was, they'd say, what are you talking about? On February 9th, the ratio of the NDX divided by the Dow Industrials, and think about that for a minute. I want your audience to think about it for a minute. That simply tells you how the NDX is performing in relationship to the Dow. Speculative technology versus, theoretically at least, more conservative in the Dow. And on February 9th, we reached a 46% ratio with that reading, NDX divided by Dow.
By the way, you're talking about the NASDAQ. You're talking about the NASDAQ 100. Just want to clarify that, but go ahead.
That's correct.
Technology,
the NDX,
by and large, but go ahead.
NASDAQ 100. Exactly. And we reached a ratio on February 9th, what we've only seen twice before in history, Neil. One of them was, I think, March 10th, but it was March of 2000, and the other one was November 19th of 2000. The first one led to a decline of 83.5%. The second one led to a decline of almost 40%. So now we saw that reading on February 9th. You say, well, I guess you were wrong, Peter. We're basically where we were back on February 9th. The important thing is that we have not gone any higher. The highest we've gone since that 46% reading on a closing weekly basis, Neil, is about 2%. So I'm getting a little stir crazy here myself, because I think the way I interpret it, and I may be wrong, is that this market is so speculative that people do not want to give up the hope that we are indeed in the type of market that might not ever go down for a long, long time. And the reason, of course, as you and I know, is artificial intelligence. Yeah. Everyone thinks that changes the ball game completely. Well, I would propose to you that at every market peak in history, people think that something's happening that's going to change the ball game completely, and somehow that something never happens.
But you're a technician, right, Peter? I didn't mean to jump in you, my friend, but you're a technician. You look at things that a lot of others don't, more general fundamental types who say, all right, this is a presidential election year, almost always great for the markets, and that the factors favor the markets continuing to advance. On that basis alone, and a Federal Reserve, for example, that might be holding pat, but might be then more prone in the months to come to cut rates. None of that matters to you.
Well, it's difficult to say none of it matters to me, but it has very little significance to my outlook in terms of timing the market, Neil. Let me give you a statistic, Neil. You know how I am with numbers, right?
Yes, I do.
Let me give you a statistic that I think will blow your mind and those of your listeners. This is something that's fundamentally oriented, but there have been only 3 prior times in history where the dividend, I'm thinking, what do they call it now? The yield curve. The yield curve's in negative territory now, right? There have only been 3 other times in history where the yield curve has been negative for 100. I'm getting my data here.
Where longer-term rates are lower than shorter-term, right? And that could be worrisome, right? But go ahead.
Yeah, but this is important, Neil. It's a very specific statistic. It's only 3 previous times where the yield curve has been negative for over 500 days. Those times were, are you ready? 1929, 1974, and 2008. Each one of those led to declines of greater than 50% in the equity market.
Is that what you're seeing now? Is that what you're seeing now?
Yes, we've now been had a negative yield curve for over 500 days. Now that's not my statistic, and usually I try to give attribution, but I don't remember where I saw it. So
Okay.
if I don't do some research myself, I don't want someone to say, "Well, you stole that from me."
No.
I didn't steal it.
That would never happen with you. But Peter, let's say you're right on this. There are a lot of people who are going to quibble with that. But if you're right, how soon does this happen? I know you can't time these to the day or the week or even the month. And sometimes markets have a way of going beyond what the statistics say should be the case. But what's the latest that this begins to unravel?
That's a good question, Neil, and because it's not my research, I can't give you the exact numbers or dates on that. All I know is that after the 500 days expires of a negative yield curve, then that's the point at which market declines not necessarily immediately begin, but I would guess, looking at the three dates that I'm looking at, 1929, 1974, and 2008, that it occurred pretty quickly after you saw something like that happen. That's pretty scary, and it fits in with everything else. I made another discovery, Neil, and it's very closely related to the NDX, the NASDAQ 100, right, divided by the Dow. And I started to think, I said, wait a minute now, that's the NASDAQ. And yeah, technology stocks, but no, not all directly related to AI. I said, what index is? And it's the SOX, the Philadelphia Semiconductor Index. Let me throw this.
A chip index that mirrors technology in it.
Semiconductor index, okay. Yep, chip index, which is very closely aligned with artificial intelligence. Yikes. Let me throw this statistic out, Neil. On March, I may screw up by a few days on the dates now, but I think it's March 10th of 2000, we had a ratio of 13.4%. SOX divided by Dow Industrials. That was the exact day of the high in 2000. We came nowhere near that ratio for the next 10, 15, 20 years, not even in 2021. When the NDX ratio equaled the 2000 ratio.
All right, but bottom line, I'm jumping on you, my friend, rudely. I wish we had more time. Bottom line, we're in for a storm here. I hope you're wrong, but I wanted viewers to hear from you because you are widely respected. You have been right in some big crashes we've seen in the past. So, Peter, let's have you back, see how this sorts out. Peter Eliades on that.